Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Okay, everybody, welcome to the podcast. This one is very exciting for me. We at the Wolf Group, we have so many clients that are working for different international organizations throughout the world. And any of the international organizations that touch the European Union, those individuals always happen to be in Belgium, which I hear is I never visited. I've never been there. It's one of my bucket list places to go to. But we have a ton of clients that work and live in Belgium from the US. And then fascinating enough, Belgium actually has, in my opinion, one of the top 5 tax treaties with the US. Yeah, so it's a little known thing there with the tax treaty that people always ask me, which countries have the best tax treaty? And obviously maybe Canada, UK, but Belgium I think is in number 3, 4, 5, somewhere in there. So today we've got Erik Sansen, who's going to tell us a little bit about Belgium, walk us through the tax rules there. We're going to talk specifically about U.S. people coming inbound into Belgium. So before I pepper him with questions related to those rules, Erik, why don't you tell the audience a little bit about yourself, your background, your firm, all that good stuff.
Yes, hi, Mitch. Nice to meet you, and happy to be in this podcast. I'm Erik Sansen, as you mentioned, and I founded the firm Sansen International Tax Lawyers almost 12 years ago. Previously, I was working at Loyens & Loeff back in time, and since the very beginning, I was involved in, well, let's say, international tax matters, being clients relocating, companies shifting from to another company to another country, restructurings. So that was actually the reason of our existence when I started the law firm back in 2014, and ever since we have been advising clients when doing businesses internationally, when investing internationally, but also focusing on the strictly Belgian tax matters, of course, because in the end, I'm also a Belgian tax lawyer.
All right, perfect, love it. Okay. So my first question, and I think this is what a lot of people want to know, what does Belgium have to offer? Why are we seeing a lot of global mobility families, private investors kind of going inbound into Belgium? I think in some parts of Europe, people are scrambling to get out, right? So we know that, with the new UK tax laws, no one really wants to, or I won't say nobody, but some of these folks probably want out because of the punitive tax regime. So we're seeing really some shifts in Europe as far as the tax regimes forcing people in and out. But tell us why Belgium?
Well, actually, historically, Belgium has been very attractive and still is, maybe a little bit less than previously, but still is. But historically, it was no capital gains taxation. Dividends were taxed at quite substantial low rates. Interest was taxed at 15%. Liquidation proceeds were not taxed. There is a lot of potential. There is a lot of options to do estate planning to avoid inheritance taxes. We never had wealth tax. We have a small wealth tax now, but historically we didn't. Previously, also in an international context, pensions, mostly lump sum payments, were and still are taxed at interesting rates. So there were a lot of reasons why people were interested in Belgium, but still there is a lot of potential to attract, let's say, high worth individuals. For example, the capital gains was introduced, but it is in an international context still an acceptable tax rate. We will come back to that later on, I guess. And yeah, there was some small wealth tax, but it's not a general wealth tax. And we still have options to invest in wrapping products such as life insurance products or collective investment vehicles where you can, postpone the taxation. So it is still attractive, but yet a little bit less than previously. And then it was, a paradise for wealthy individuals. Now it's still attractive, but a less paradise, let's say.
Right. No, totally get that. And we'll definitely go through some of the different rates that you kind of pointed out there and the little touch points that we've got going on.
Yeah.
But that's a super interesting take on that. For those that don't know, the life insurance wrappers generally, those are very, very sought out for in Europe, in my opinion. A lot of people try to get those. It's both a life insurance product and typically an investment vehicle of some kind, potentially maybe in some kind of mutual fund or funds plural. Something that drives the payment for the fees and all that stuff. So I'm probably gonna do an entire podcast on life insurance wrappers and kind of how those things work with primarily Swiss life insurance wrappers, but maybe I can find some examples from Belgium.
Luxembourg as well. Yeah.
Okay, let's go back to basics, and you're gonna have to talk to me like I'm a 3-year-old here, Eric. So tell me about tax residency in Belgium. So I'm a U.S. person. I get assigned to go work at an international organization in Belgium, or a company in Belgium. And when do I become a tax resident of Belgium? What can I expect when I become a tax resident of Belgium? Is there any special programs for me as a new tax resident that I need to be aware of and work the joints on?
Well, first of all, the Belgian tax authorities will be welcoming you with open arms. So it's very easy to become a Belgian tax resident. So you just registered in the Belgian population register, and as of that moment, you are deemed to have become a Belgian tax resident. So it's as simple as that. Of course, it is more than that. So the facts are, of course, predominant. Tax residency is not determined as, for example, in the US, taking into account the number of days you spent in Belgium. It's a set of facts which points out that your personal place where your personal interests are located in Belgium. So that means that they look at where you spend your time, where are your friends, where's your family, where are your sport memberships, etc., etc. And of course, the number of days you spend in Belgium is equally important, but is one of the facts that determine your residency. And apart from that, if your personal interests are not located in Belgium, a second criterion that might apply is where your seat of fortune is located. And that does not mean where your fortune is actually located, but is the place from where you are managing your wealth. So 2 criteria, but mostly, of course, it is important to get rid of the tax residency of the country you're leaving, i.e. US in this case. So, but it is actually, from a Belgian perspective, quite easy to become a Belgian tax resident.
Okay. All right. And if I'm a Belgian tax resident subject to Belgian tax, am I generally going to be filing a tax return? And if so, when is that due?
Yeah, so actually this is due when you file the paper version, usually at the end of June of the year after. If you're filing an electronic return, it's normally mid-July. But if you're filing, if you have foreign income, such as professional income, or it's you have a legal construction, this is a kind of offshore construction, which is determined as defined by the Belgian Cayman tax law, to which we come back later on. Then you have an additional timeline until mid-October. So it is quite a longer term than which is the usual term for US persons that need to file normally, if I'm not mistaken, somewhere around April. Here in Belgium, it's quite a bit later in the year. But of course, the challenge is always that for as US person having US citizenship, there's always this complexity of having to file still when you're a Belgian tax resident in the US. And luckily enough, there is a good, as you mentioned in the beginning of the call, very good double tax treaty, where the Belgian tax authorities did a good job, and also the US ones, because there is a lot of protection included in the treaty to avoid the double taxation.
Yes, it really is one of my favorite treaties. I can't overstate that enough.
Happy to hear.
Yeah. Okay. Now, help my fellow U.S. tax advisors, CPAs out. When should they get involved? Like, when do you I always tell people it's kind of like dancing. I let the foreign country go. So if my client is in your country and you're their tax advisor, I'm always like, go talk to Eric. let Eric set you up for success, and then bring us in, make sure we're obviously conversing. Big no-no is to not have your cross-border tax advisors talk. Like, you should always have them talk, and sometimes it's better to let the professionals kind of hash it out and not be the middle person. But
Hmm.
I would let the host country, or the country that you're living in, that should really go first, because generally they're going to have the first right to tax everything, and then on the back end, we can kind of modify and come around and say, okay, well, if they're going to tax X, Y, and Z, then maybe we need to
Mm.
under the treaty, et cetera, et cetera. So, like, help my fellow colleagues out here. When should they get involved? What fact patterns do you generally see? Kind of what's some good 50,000-foot advice that you would give them?
Well, the very important matter that sometimes is forgotten on the US side is that we have a different look of things, such as trusts, such as Delaware LPs, mainly used for investing in through a fund in a portfolio company in the US, which is sometimes, well, mostly a mismatch with the Belgian tax regimes, but also when people are continuing their businesses in the US through an LLC. And for example, an LLC mostly is a legal entity, yet not subject to taxes itself, which is something we are, where the tax authorities in Belgium, they are blurred at all, mainly because they do not accept the tax transparent approach when an entity is a legal entity. So it's a mismatch. Luckily enough, we have the treaty, but yet, still then, in many cases, the LLCs are used, but there is no income taxed in the US because there is no connective income. So there is no genuine presence in the US. So people believe that they don't have to pay taxes nowhere because as long as there is no distribution, they believe, to Belgium, there is no taxation. And in the US, no income taxes are being paid either. So that's, of course, a misunderstanding, mainly because if the actual seat of management is taking place in Belgium, the Belgian tax authorities can claim the company to be a Belgian company subject to Belgian corporate taxes, or even worse, it can be considered as a Cayman tax structure. It's not I'm not referring to the Cayman Islands, but it's the word that's used in Belgium to address the kind of CFC legislation, controlled foreign company legislation, where we look through these companies. So these are the very specific points of attention we regularly often meet in daily practice.
Yeah, so I interpret that, and again, I would caution the audience, things like the limited liability company is a state designated function, but for federal tax purposes, generally, you're either a disregarded entity if you're a sole
Mhm.
member LLC, or you
Mhm.
can make an election to be an S corporation, which is
Yeah.
trouble here, or a
Mhm.
C corporation, which I think that's harmonized. If it's a multi-member, then it's a partnership, an S corporation or a C corporation. But and maybe I'm on my high horse here because I'm always trying to educate the rest of the world on the S corp. But the S corp tends to be the problem child for a lot of people, I think. Very popular here in the United States, but not very well known or accepted outside the U.S. And then I would also tell people the revocable trust, which really doesn't exist for our purposes until something happens. That can also be a real, because again, the a lot of foreign countries will look at those setups and say, well, we're going to tax that entity, but there's no real, there's nothing to tax on the U.S. side because everything will be as a flow through. And we don't allow a credit. So if they do end up taxing you for their corporate tax credit or trust rates, whatever it is, there's no way for us to give relief for the foreign taxes paid. And so that could be, a big issue. And so what I would tell people kind of going to Belgium, that'd be one of the things I would highlight to the Belgian tax advisor for pre-immigration tax planning. Hey, these are the things that I have. Are they going to create problems? How can we restructure before we get there?
Exactly. Yeah. Or maybe if the shit hits the fan already,
Yeah.
pardon my French,
No, no.
is to find a way to avoid issues, and mainly with the Belgian tax authorities. For example, you might consider setting up a Belgian management company where all the work that is done from Belgium is being invoiced to the US entity, be it an S-Corp or an LLC, where at least you have your fair share of taxes paid in Belgium. But the work that is made, for example, done by a local team is, and is generating income in the US is taxed in the US. So that might be a way around it. But of course, it's always a tailor-made solution you have to find. That's true.
Yeah, and in that tailor-made solution, just for the folks listening from the US side, my advice is if you're going to set up that Belgium company, make it a single member company and do a check the box election within 75 days of creating it here in the US. So you out of the US CFC. Yeah, Eric mentioned earlier the CFC regime, which I'm telling you, it doesn't matter what country you're in. If they say the word CFC, that's trouble. That's going to be a costly exercise if the word CFC starts getting thrown around. Okay, but to pull yourself completely out of that, create the entity. Don't do anything with it. Don't put any appreciated assets or anything in there. Make your check the box selection within 75 days of creating it, and then you're off to the races. It's a foreign disregarded entity. Very easy filing here in the US. Everything passes through the entity taxes, the business entity taxes.
You can offset your taxes also, indeed. Yeah, that's true. Yeah. No, I was just saying that trusts are another challenge because I know that many US citizens or US persons, they set up a trust for inheritance purposes to avoid probate, to have to go to court as a heir. But this is also something which is quite dodgy for US Belgian authorities or EU authorities in general, because it's a Anglo-Saxon vehicle. We're familiar with foundations, but trust is something strange. So, and we have this annoying legislation, the Cayman tax I referred to already, but also from an inheritance perspective, it's mostly an issue. So it's something that is also have to be checked before coming to Belgium, for example.
Oh, absolutely. And so for the folks at home listening, what Eric is highlighting, so I'm a big fan of history. He's highlighting the common difference between civil law and common law. So think the Romans versus kings.
Exactly. Yeah.
That's kind of where we're at on that. But if for those listening also, what he's referring to are the revocable trusts. If you go to the podcast I did with John Deedon just recently, he talks about the just general estate planning, the 5 things you need to know for US estate planning. Some of those things aren't going to comport really well once you get to countries like Belgium or any of the EU countries. So again, that's another thing that you want to kind of plan for before you go inbound into Belgium. Let's switch topics here for a sec. What about US retirement plans? Any of those throw for a loop when they get to Belgium?
Well, there again, they did a good job when negotiating the treaty. So a normal IRA pension plan is just taxable in Belgium. The resident state will tax, and there might be some opportunities there if in case of lump sum payments where there might be favorable tax treatments, where the rates can be below 20%. But of course, as US citizen, you still have to take into account that on top of it, you will end up paying the income taxes in the US. But there are Belgians having worked in the US, returning to Belgium without US citizenship. And for them, it might be an interesting way of getting their IRA paid out. And on top of that, an IRA Roth is specifically exempted by virtue of the treaty, even though Belgium is allowed to tax, yet it is forbidden to tax in the end if it's IRA Roth. So there again, the treaty is very favorable.
Yeah, absolutely. So for those that don't know, there were only 8 countries in the world that had a favorable Roth IRA provision. Chile, which is the newest country to get a tax treaty with the US, which is the first country in I think over 16 years to get a kind of tax treaty with us formalized in the Senate. That's a whole other podcast though for me to go into why that's the case. But their recent tax treaty, which is the first one out of South America, actually has a Roth IRA provision in it. I mean, I think any new one that comes out will have one in there. But there's only 5 countries in the world that have it. Belgium is one of them. So again, great job there. Okay, let's talk about tax law changes. So what's happening here in 2026? Did some things change that you want to kind of highlight?
Well, we have kind of a game shifter.
Okay. Game changer.
Well, we had a capital gains tax, so it's a misunderstanding that there was no capital gains tax in Belgium, but there was only in very specific circumstances so far. So until the end of last year, you were only taxed, taxable capital gains were only taxed in a very specific context which is not interesting in this topic. But apart from that, only if you were managing your assets, your private assets, in an abnormal way. Abnormal as in short-term capital gains, taking risks, etc., etc. So when you just were, purchasing as listed securities, shares, and you were just selling them, mostly it was considered as someone who's just managing his assets properly, and so no capital gains tax. Otherwise, 33%. So what happens in 2025? They decided to introduce, as of this year, 2026, a general capital gains tax, even though you're just managing your assets in a normal way, just investing your private assets. It has been decided that you will end up paying 10% capital gains tax. At the same time, they kept the abnormal qualification of capital gains, so they kept the 33% tax rate. They also introduced a new taxation, which is maybe less interesting today, but just to give you an insight, if you sell your company to a company of which you are in control, then it's a 33% taxation. But the 10% regime is actually the general regime applicable now. Important to tell you is that there is a historical step up in value. So the acquisition value is set at the value at the 31st of December 2025. Apart from that, it's quite interesting for substantial shareholders, meaning people having more 20% or more of the shares. They can enjoy an exemption up to 1 million, and then a progressive income tax rate going from 1.25% to 2.5%, and then 5% of a 5 million, and then only as of 10 million capital gain, you will be paying the 10%. So it's, for substantial shareholders, quite interesting to sell your shares in Belgium. Still, it's interesting. And on top of that, people coming into Belgium, that's interesting for the newcomers, there's a step up in value as well. So if you would arrive early 2027, if you can determine the value at that moment, and there is no exit tax to be paid in the US, for example, if you're not a US citizen or green card holder, for more than 8 years, then you can have a step up and only pay taxes in Belgium, capital gains taxes on the value accruing after that.
Okay, wow, that's interesting.
So it's quite still interesting, but of course, no one knows what the future will bring. Will they increase the tax rates? No one knows.
Okay. And if they were going to do that, do you know, like, when that probably would come in? Would that be 2028?
I hope this doesn't happen with this government, but maybe next government. If it's a left-wing government, it's easy set to a higher percentage. And if you know that the percentage of dividend taxation is 30%,
right,
it is not to be excluded that will be set at the same rate. I don't know. We'll see what the future brings. But so far, it's, in an international context, still a very attractive tax rate, of course.
Okay. And as a reminder to the folks at home, so when applying the foreign tax credits, if the rates are substantially different, for higher, we have the wacky high tax kick out. There are ways to kind of work around that. For lower rates, you have the capital gains adjustment rules, which I know throw a lot of US CPAs for a fit. That can be a mind-boggling exercise on the form 1116. And then lastly, we've got the contentious net investment income tax, which is working its way through the courts right now on whether or not a foreign tax credit can apply to that. That's 3.8% on passive income, interest, dividends, cap gains, rents. So keep that in mind when applying that to these things. Okay, let's talk about gift, estate, and inheritance tax, because that's always something that people don't ever think about. No one ever, very rarely, I would say, and that ever comes to top of mind for a lot of people. Tell us about how gifts. Give us all the details about gift, estate, and inheritance from the Belgian point of
view. Yeah, well, indeed, we do not have a large exemption as US persons have in inheritance taxes and gift taxes. If I'm not mistaken, it's up to 11 million nowadays. 15 million already, so it's increased ever since. So we do not know this. So inheritance taxes are due. It's determined by each region. We have 3 regions: the Flemish, the Walloon, and the Brussels capital region. But mostly it's around 27% as of 250,000 euros. So it's quite substantial. However, we provide the option to have, to decrease the tax burden substantially to only 3% in direct line or 7% to further relatives, meaning 3% of gift taxes if you start donating during your life. So what people do in Belgium, they timely start considering initiating their inheritance planning, and there's a possibility to gift away your movable assets as a 3%. It's not applicable to immovable assets. There the normal rates apply, going up to 27% or even around 27% in general in Belgium. So for movable assets, such as shares in a company, if it's normally it's 3%, but if it's a family business, you can donate the shares at even 0% rates. If it's a family business carrying out a general economic activity, there is an exception introduced this year. Insofar residential properties are being held by that very same company, that part of the shares will still undergo the 3% rates, but we do have this interesting 0% rates for gifting your company timely. If that very same company is inherited, it's a 3% rate, which is applicable as to inheritance tax rate. So it's also lower rates, substantially lower than the 27%. So you can even avoid paying gift taxes. And for this, to explain this, I need to give you a bit technical explanation, but I want to avoid to become too technical for the audience. But it's important to know that most countries, they do apply gift taxes because I am a resident of Belgium, or I'm a donee of Belgium, or I'm donating Belgian assets. That's irrelevant. So I'm only paying gift taxes on movable assets because when the title of donation is being registered, it's a stamp duty. And this donation is mandatorily registered when a donation takes place before a notary public in Belgium or abroad. So the 3% is always due because a direct donation always needs to be done before a notary. However, if you wire, for example, money or a security portfolio from one bank account to another bank account of the donee, and you're not mentioning anything on the donation on the transfer, and afterwards you tell the donee that has been a donation, so has become indirect donation, not a direct donation. It is not a donation that needs to be registered. It's not a donation that needs to be taking place before notary. Only direct donation needs to be done before notary public. So if you do it indirectly, such as a wire transfer, you don't have to go to the notary. So there is no obligation to register the title of donation. And then you don't have to pay gift taxes. The only thing that happens then is if you decease within 5 years' time, then you still pay the inheritance taxes at the high rates of 27%. So it's a risk to be taken. But what can happen is that, for example, you get ill and you get cancer. You can still go and register the title of donation of 4 years ago, and the day afterwards you can die and you will not pay the 27%. So there's a lot of planning opportunities around this donation, but it's always needed to donate. You have to gift away during your life to avoid the high amount of inheritance taxes.
Okay. And if I gift during life, is the basis of the asset that I'm gifting carryover, or does the donee get a step up?
No. So indeed, for capital, to come back to capital gains, because it's important to know indeed, if I donate, there is no capital gain taxation triggered. So it's
Okay.
only when I transfer it, not for free. So for consideration, then capital gains taxation is triggered. So as donee, I take over the acquisition value, the historical acquisition value of the donor.
Okay.
Same applies when I inherited financial assets. At that moment, there will be no taxation due. Only when I sell afterwards, the capital gains will be calculated taking into account the historical acquisition value. There's one thing that you should note, that the audience should know, that, for example, if I have 3 brothers and I inherit together with my 3 brothers a security portfolio, financial assets, which are kept in joint ownership. At the moment, there is a partition of the joint ownership. This is a transaction for consideration, and then in that regard, there might be capital gains tax. However, it has been provided in law that if that happens within 3 years after the donation or after the inheritance, there is no taxation due at that moment. So the only taxation that will happen then if you sell afterwards the financial assets.
Okay, got it. And then last question on the gifting.
Mhm.
If do I need to get a valuation or an appraisal on some things where the value is not readily ascertainable? And if so, how do I do that?
Well, yeah. So there are. It needs to be, the arm's length value which is applied, which is used for gift and inheritance tax purposes. There are options, possibilities to have this assessed and confirmed by experts, acknowledged by the Flemish, for example, authorities who are responsible for the collection of inheritance taxes. So you can have this confirmed by approved experts. Yeah.
Okay.
To be sure.
I will note to the audience that unfortunately there is no US-Belgium estate tax treaty.
True.
So that's one of the areas that there's a little bit of a downfall. That being said, those estate tax treaties, for anyone that's ever read those are written in the Queen's English way back in like the 20s, and they're very difficult to understand anyway. So I still think you could probably get a good result though either way, to be real honest.
Yeah, but indeed, in the meantime, it's been accepted that US estate taxes can be credited against the Belgian inheritance taxes. Yeah.
So that it's
unilaterally. Yeah.
Okay. All right. Let's move on to pre-immigration tax planning, because I always tell folks, because people are like, okay, you're going to refer me to Erik. What do I ask Erik? And I'm like, you ask Erik, you tell Erik, I need pre-immigration tax planning for Belgium. That's what you add. That's what the ask is, right? For someone that's moving inbound in there, or inbound into any foreign country, what you're asking for is pre-immigration tax planning. And that should be enough to tell that person, okay, this is someone that is coming in that needs us to do an analysis to set them up for success. I think I speak on behalf of every single tax advisor in the world. It's easier to do the pre-immigration tax planning than if they just come in, get set up, and then they come get 2 or 3 years later and they're like, well, no one, I didn't really know what to do, and I just went ahead and did a bunch of stuff. It's easier to plan for it beforehand, in my opinion, than to try to unwind it later on once they're set up. So tell our audience, what do you see, and what are some of the mobility traps you see in practice? What are some things that you see that people kind of fall into that don't heed our advice to do pre-immigration tax planning?
Well, yeah. So the thing is that in many cases, foreign advisors, they tend to forget the specifics of Belgian taxes. And one of these specifics is I already referred to the Cayman tax, the Belgian version of the CFC legislation applicable to private individuals.
Okay.
So what I've seen before is that advisors were restructuring companies and entities with Belgian shareholders involved without, realizing that this restructuring, which in a normal tax regime would not affect at all the shareholders, does affect the shareholder in Belgium, because any shifting of shares that are in companies that are considered as so-called offshore legal constructions as defined by the Belgian tax, the Cayman tax law, any shifting of these shares might trigger a deemed dividend distribution on their behalf.
Yep.
taxable at 30%. So that's quite a heavy impact for some Belgian shareholders or US persons having moved to Belgium and having become a Belgian shareholder. So this is a very important to assess the impact of the Belgian Cayman tax, which is normal. It is normal actually that tax advisor, they do not realize that might impact shareholders, because normally if you transfer the seat of a company from one country to another, that should not trigger anything, but it might trigger the deemed dividend taxation on behalf of Belgian shareholder if it's a legal construction. Having said that, the typical pre-immigration planning to look at is, as I mentioned before, is what to do with the trusts. Will I accept the applicability of the Cayman tax to that trusts where any income generated by that trusts attributable to the founder or the heir of the founder in Belgium and taxable on his behalf, even though he's not getting that money? Do I accept this consequence, or should I restructure this, or should I unwind the trust? Or is this a trust which is in scope of Cayman tax? Sometimes we might find arguments to tell, well, it's kind of a trust arrangement, but there are arguments to claim that it's outside of scope, then it's okay. So these are the typical things to be looked at preferably before coming into Belgium, such as also the LLCs. Shall I keep my LLC, or should I elect for C-Corp taxation in the US to avoid this hybrid mismatch? These are the typical things we need to check before people get into Belgium. Yeah.
Okay. Let's shift gears to our C-level executives. Side note here to the listeners in the audience, a lot of the folks that I deal with that are C-level, meaning they've got RSUs, stock options, parachute plans, all that stuff. I just want to point out that, in my opinion, a lot of the internal accounting by US companies is done very poorly. And a lot of the income that flows through on our income forms, our W-2s, are not always accurate and correct. People always just take our W-2 pay statement as gospel, like, oh, this is my income for the year. And I always tell people, you got to double check that thing, especially if you're C-level, because if you have RSUs, stock options, non-qualified stock options, parachute plans, I mean, you're asking HR people that don't know anything, probably know nothing about tax. And I'm married to an HR person, so my wife married years. So I say this with all due respect, but I'm telling you, be real careful about trusting that on your W-2. Okay, now let's talk about carrying all of that into Belgium. What do we tell our C-level folks that are flowing over into Belgium?
Two main points there. Previously, we had this period where multinationals, US multinationals, engaging Belgian residents as employee, C-levels, not knowing that actually there should be income tax paid on the RSUs attributed to them. Even though it was attributed by the foreign non-Belgian US multinational of the group, where the employee was just on the payroll of the Belgian group company, even then it was taxable, but they didn't realize. So there was a lot of hassle a number of years ago, where actually the special investigation squads was, looking into a lot of matters where a lot of penalties had to be paid. So nowadays they do know in Belgium income tax need to be paid, and certificates need to be issued by the Belgian group company to allow the Belgian tax authorities to know of the existence of the RSUs. So that has been settled. A second thing, what people did not realize for a long time, but nowadays it's getting through the minds, is that estate taxes are due in the US because it's US assets.
Right.
And above the 60,000 threshold, if I'm not mistaken, in the US, you need to pay estate taxes.
Yeah.
And so many people, they do not know this, or so far, but it's getting changed, and we have a lot of rectifications going on now with the IRS, where the widow or the children are now confronted with issues to get the money freed from the platform, such as Fidelity, if I'm not mistaken, and all these platforms in the US, where they don't want to release until the estate taxes are paid. So these are the typical issues we face at at the same time, stock options, which is a incentive plan which is commonly used in Belgium. I know RSU is a typical US version, but stock options as well. And this is something which might, be leading to issues if not monitored properly, because Belgium is, to my knowledge, one of the few countries in the world who taxes stock options upon grant and not upon exercise.
Okay.
Which is for mobile, so for a sea level, which is very mobile, moving from country to country in several years chronologically, might give issues, because it's interesting in itself, because you're taxed at grant on a forfeit basis, not on a genuine value, but on a forfeit basis, mostly around 18% of the underlying value of the shares, where you pay the normal progressive income tax rates on that taxable basis. So for startups, it's very interesting. But also for more mature companies, it is an interesting incentive, of course, assuming that the value goes up, because upon exercise of the options and upon sale, the capital gain is not taxed at all. And is also within the frame of the new capital gains tax regime. So there's a special exemption for capital gains realized upon exercise of your stock options and immediate sale. But of course, if you relocate afterwards to another country, that country might try to tax you at moment of exercise. For example, the US, you will be taxed at that moment. So it's, of course, you have to apply the double tax treaties, where you can claim that, for example, US can only tax for the pro rata where you have been working in the US, and Belgium should be allowed to tax the other years and another cut. So this is the typical mismatch for incentive plans such as stock options. But it's a matter of monitoring it properly as a company, but also as an advisor of that company. Yeah.
Okay. Yeah, that's super interesting. And there's a couple, when you were talking about that, there's a couple of creative solutions that I thought in my head that could work to combat that. And obviously you've got the treaty in there too. Okay, let's talk about one last thing related to pre-immigration tax planning. Do you have like a general checklist or just a quick rundown of things you like to tell advisors or accountants to be on the lookout for their clients when coming inbound into Belgium? Is there any wisdom you want to share on the I always think of checklists like a pilot taking off on a plane, like they're going to make sure everything is working before they launch off. So any big things that stick out to you there that you would just say, obviously I think we've talked about, the stock options, the Cayman rules, but any other big things that you would add to that list that you would?
Well, mostly I would say the remaining check the box to be checked. I mean, is of a non-fiscal nature. Which bank will you choose as U.S. citizen within the frame of FATCA? Because not all banks are very keen on welcoming U.S. persons as a client because of all, as you know, administrative burden that is, triggering this. And of course, at the same time, if a bank accepts you as a client, how will I invest? Because you're not allowed to invest in anything you would like to invest in. So this is a non-fiscal aspect, but equally important. I know you have this PFIX in the US, but from a Belgian perspective, non-having US citizenship, then it's interesting to invest in, for example, Luxembourg SICAV, because it's a wrapper. So you only tax at capital gains is only due when you distribute, when there is, a redemption of the shares. But at the same time, as a US citizen, you would be punished to invest in a SICAV. So it's a matter of just also screening your securities portfolio and how to deal with it within the new context of being a Belgian tax resident.
Yeah. So for those that want to know more about the PFIC rules, I think the 2 episodes prior to this one, I did talk about PFIX with Mary Beth Logan, who is in my opinion, the preeminent expert on PFIX. But the CCABs, specifically, whenever I see that term, I always shake my head because I know where PFIC landed. Commonly in Spain, I haven't seen CCABs too much in Belgium, but I've seen those all over Spain. It's like, oh, what bank are you with in Spain? And they'll tell me, and I'm like, oh, you have a CCAB. I know you do. and then they're like, yeah, we have one of those. And I'm like, oh no, yeah, that can always be an issue. Okay, very quickly, so that we can just tie the loop on it. Walk us through the tax rates, because I think we mentioned earlier that there was a wealth tax, and just generally speaking, ordinary income, wealth tax rates, any other rates that you want to share for the audience so that they can tick and tie them down.
So we have this 0.3 wealth tax only due on securities, listed securities, such as bonds, stock. So this is the one that is due, even though it's kept outside of Belgium, you have to comply with that tax. We have also a specific tax when you're selling your stock or purchasing stock, listed stock, which is very low, but still needs to be complied with. And even though it's kept on a foreign bank account, you have to comply with it yourself. Then we have dividends and interest tax at 30%, capital gains, as said, at 10%. Professional income is heavily taxed, up to more than 50%, including the municipality taxes. Yet at the same time, we can decrease the burden of taxes by using a management company if you're a self-employed worker, where the global tax burden could be decreased to only around 35%. So with the same rate as the federal rate, if I'm not mistaken, in the US. And for the rest, pension capital, lump sum payments are favorably taxed. And as to private estate, I think I've mentioned all taxes which are due, except for inheritance taxes, which we previously discussed, of course. Yeah.
Okay. All right. And I'll remind people that on that management company that Erik just mentioned, same principle applies. Do your check the box selection. Everything flows through for US tax purposes. That should harmonize everything. That requires, though, the Form 8858 for those of you keeping score at home on your US tax return. All right, Erik, last question for you, and then we'll let you go. You've been so pleasant and informative. I'm really loving the vibe here. Okay, what is the process for someone to reach out to speak with you? So if client says to me, Mish, I'm going inbound into Belgium. I need to hook up with the Belgian tax advisor. What, am I just basically just copying and pasting your details? What should they expect when they contact you?
Well, it's funny nowadays how many people find us through just ChatGPT. They mention Belgian international taxes and they find us directly. It's like we're popping up immediately. But apart from that, the usual way to approach us is sending us an email to me directly, Erik@sanseninternational.tax, or at our general email box, office@sanseninternational.tax, or any other partner working at our firm. You can find us on the website, www.sanseninternational.tax.
Okay, perfect. And we'll link all of that in the show notes in the podcast. And then, Erik, if there's any other materials, obviously, that you think that are relevant to today's conversation that you want to link up there for the audience, we'll go ahead and put those in as well. Thank you again for coming on. It's been so nice to finally get the details on going inbound into Belgium.
Thank you for having me, and it was nice speaking with you as well. It was a pleasant conversation. Thanks a lot.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.